Hello, hello, hello. Welcome back to the Perpetual Motion, the show dedicated to providing information on business and money without the bullshit. Today, we're looking at a shakeup in the gambling space with prediction markets and a segment of hot or not, looking at some of today's best and worst performing stocks. Let's get it. Alrighty, people. First things first. All bets are off in the gambling market with the rise of prediction markets such as Kalshi and Polymarket. We talked a little bit about Kalshi a few episodes ago and the kind of mystical path to approval it took here in the US. Today's focus is on Polymarket, which I talked about briefly. It is a very similar platform where you can find essentially the same style of bets or predictions, as the company has termed them. Polymarket is in the news today because of a recent investment into the company of $2 billion. This investment has officially made the founder and CEO, Shane Copeland, the youngest self-made billionaire. Now, call me crazy, but this guy looks suspiciously like another young billionaire, Sam Bankman-Fried. And we remember how that went. I'm not calling this fraud, but I do find the similarity a little bit humorous. In any case, the company that owns the New York Stock Exchange, you might not have known that was a thing, but New York Stock Exchange is a business. The Intercontinental Exchange, also known as ICE, invested the $2 billion we talked about. No, it's not that ICE, or the other ICE, not even this ICE. This investment brings the valuation of Polymarket to $8 billion. Or 4 times the valuation of its rival Kalshi, which we had talked about, after it raised $185 million back in June. Notably, Polymarket is not allowed to offer services to users in the United States yet, following an investigation around the time of the last US presidential election. That investigation has since been dropped, and following this investment from ICE, many people see approval coming down the pipeline very soon. Some specifics of this deal with ICE include ICE itself becoming a global distributor of Polymarket data, which could soon be kind of integrated into feeds used by thousands of financial institutions across the globe. Interestingly, from elections to sporting events, the platform has proved to be more accurate than traditional surveys of opinion polls.
Government by the people, of the people, for the people. But the people are retarded.
Validating the idea that financially incentivized markets generate more reliable crowdsourced predictions. What a thought. When there's money on the line, it's almost like people are more thoughtful about their decisions. Crazy. Now you might be thinking, sounds like Polymarket is about to wipe out Kalshi once it gets approval. It'll have greater distribution, it seems like there's more money behind it, $8 billion, $2 billion valuation. Pretty big difference between the two. However, something we can look at to judge this battle is the trading volume on each platform, which is essentially how much money is being traded on the platform over a period of time. So in the week leading up to September 29th, Kalshi's market share stood at 67%.
6-7
versus Polymarket's 31%. But just a month earlier, this balance was tipped the other way. So these things are changing real quick. As this battle heats up, the fighters look to differentiate themselves through their user base and the kind of events they follow. Polymarket has more popularity among a global audience who favor kind of political betting and internationally relevant events. Meanwhile, Kalshi's most popular contracts or predictions, whatever you want to call them, tend to lean more American. Although the firm is making an effort to attract more crypto-related predictions, such as betting on crypto or some of the political stuff that might require you betting in crypto. Regardless of who wins, the market is expected to grow at 46.8% annual growth rate over the next decade. So a shit ton of growth. That's according to one study. That's a lot of growth. Almost think about dropping those little water-absorbing crocodiles in your tub for a few days and seeing what it looks like. That kind of growth. All this growth means that companies are dying to get a slice, with another frontrunner emerging called the Clearing Company. Just another company trying to get into space. Not one of the big two, though. They're fighting for it. This shakeup has drawn attention to the traditional sports betting market, whose throne is currently occupied by DraftKings and FanDuel, with the platforms having millions of users and billions in revenue annually. Shares of DraftKings fell by more than 22% in September, while Flutter, owner of FanDuel, fell over 17%, as investors sold off their positions in these companies, kind of anticipating a future in which these prediction markets are going to poach customers from the betting platforms. Yikes. We already talked about how much more volume Kalshi saw after adding sports betting to the platform, so any worries from investors or the companies themselves as the risk of these prediction markets is well founded. Personally, I see the pull towards prediction markets over traditional sportsbooks, as with the former, you're betting against other players, and with sportsbooks, you're betting against the house. This means you have better odds on these prediction platforms than you would with the sportsbook, because the house always wins. Even when you win, you wouldn't have won as much, theoretically, as you would on Kalshi or Polymarket once they get sports betting, going and regulated in the US here. On top of that, sports betting is regulated on a state-by-state basis, and it's not legal in every state. Meanwhile, prediction markets are federally regulated and legal in every state, meaning there's more market there for them to grab. And for sports betting, even in, bet-friendly states, you have to be at least 21 to bet on sports in most of those states. But prediction markets are available to anyone 18 or older, meaning there's a much larger potential customer base for these prediction markets. Now, slow down. This could mean a variety of things. You can see a large downside for these traditional platforms, such as FanDuel and DraftKings. That is, if they don't adapt. But this is the business world, and you either adapt or you die. Okay? Traditional platforms might shift to being more like these prediction markets than they are, in their current setup as traditional sportsbooks. Regardless of what actually plays out here, this is a story to follow. I really hope one of these prediction platforms goes public here soon to allow investing in them. That way, I don't have to gamble. To make some money, I can just profit off everyone else's hard work. God, I love investing. It's the greatest. It's the greatest, isn't it? Alrighty. Next up, we have Hot or Not, our segment looking at what stocks are on fire today, what stocks are not so on fire today. Just looking at biggest gainers and losers. First, molten hot lava. UiPath, ticker PATH. UiPath is a global software company that develops robotic process automation software. What the hell is that? Notably, UiPath's core product is the UiPath automation platform, which enables organizations to create software robots, also called bots or digital workers. These allow companies to automate repetitive and rule-based business processes. A little bit spooky. People talk about AI taking over. It's a little bit spooky. UiPath revealed a shift from traditional robotic process automation to what it is calling agentic automation. Here's that word again. I've used it a couple times. Told you it was going to grow. Which uses AI agents, agentic, to handle more complex tasks. To support this, the company announced a collaboration with OpenAI to build a ChatGPT connection, kind of, connecting this popular AI into business workflows, just make it more effective. UiPath also detailed partnerships with Snowflake to improve automated data processing, and with Google to use its Gemini model for voice-enabled agents. Lots going on there. These moves aim to help the businesses deploy AI more quickly and effectively. The company is up 38% since the beginning of the year, and at $17.83 a share, has set a new 52-week high. 52-week high is usually just a year, just a common term in investing. So I will say here, investors who bought $1,000 worth of UiPath shares at IPO in April of 2021 would now be looking at an investment worth just $258.55. Classic IPO story. Classic. The stock today popped more than 19% as of the news, or I guess following the news. Go automation. Am I right, guys? Yeah, go automation. Next up, super hot fire. Akero Therapeutics. Akero Therapeutics was, well, I guess I shouldn't say was yet, is a drug maker. They were, I guess not were. There's a plan announced for Novo Nordisk, another drug maker, to buy Akero Therapeutics in a deal rising to a potential $5.2 billion. Novo will pay Akero shareholders $54 per share in cash, spiking the stock 16% to, you guessed it, $54 a share. Wow. Funny how that works. Now, there's a lot that can be said here, but I'm not a biotech investor. I don't know chemistry. I'm no Walter White. So generally, I stay away from these. It's outside of my circle of competence. Not gonna bother, not gonna go into it too much. If it's getting bought out, it doesn't really matter anyways. Buying the stock now isn't gonna gain you anything. Just news, just up big, just news. Not even gonna tell you what the company makes for a drug, not even worth it. Also on fire is USA Rare Earth, ticker USAR. USAR is one of a handful of startup companies attempting to jumpstart rare earth oxide mining and rare earth magnet manufacturing in the United States. Stock is up 15% as of recording, following China's announcement of curbs on rare earth exports. The Chinese Commerce Ministry announced on Thursday that government approval will be required for exporting products containing certain rare earth metals. China dominates global mining of rare earths. They have 69% of global production, 85% of refining of these oxides, and 90% of the rare earth magnet manufacturing. They got a grip on it. They own that shit. For more than a decade, China has used its near monopoly in rare earth metals as a lever in trade negotiations, especially with the United States. In the context of President Trump's hefty tariffs imposed on Chinese exports, China is once again limiting rare earth exports to punish the US. It's actually good news for a company like USA Rare Earth, which aims to produce more of this stuff domestically to fill gaps in the supply line that lack of Chinese exports creates. Okay, sounds neat, but do I buy? In the short term, even a full-scale Chinese embargo on rare earth exports won't change the fact that USA Rare Earth has no revenue and is losing about $100 million a year. Now, analysts, for all their wisdom, do believe the company will turn a profit eventually, but by no sooner than 2028. Right. By that time, however, Trump administration is going to be heading for the door, the trade war could be over, and rare earth exports from China could be flowing freely again. Remember, we're long-term investors here, so don't get caught up in these headlines. We don't know what this means for the company 10 years from now. I also don't know much about rare earth mining. It's outside of my circle of competence. Now, you probably could find an index of these mining companies, and these rare earth companies are going to be in there. That could be a path. But don't get caught up in the headlines. Don't buy the news. There's a term that is buy the rumor, sell the news. So you don't buy the news. It's too late. If it's in the news, it's too late. At least for the most part. Now, moving on to not so hot. Ice cold. Ferrari. Ticker RACE. Race. Isn't that clever? The luxury automaker unveiled its latest long-term plan at its Capital Markets Day on Thursday. Investors weren't impressed. Ferrari said 2025 net revenue would come in at or exceed $8.24 billion, which is up from its prior projection of more than about $8 billion. It was like $7.8 billion was their previous. However, this is not high enough for investors to buy into a stock that trades at 40 times forward earnings. This means a company, if you were to buy it today, you're essentially paying for a little piece, and that piece is worth 40 times what the company is expected to make in the future. This is generally how these multiples work. If you're paying $10 for a business that makes $100, you know, what's that on earnings? That's 10 times historic earnings. So not even forward earnings. So this would be paying like, I don't even fucking know. This would be like paying just a ridiculous. You'd be paying a ridiculous. It doesn't make sense, especially for a car maker. You usually don't see this. However, the automaker also put out some long-term guidance, which was also too conservative for the market as well. Ferrari's 2030 revenue target of $10.4 billion missed the mark for Mr. Market. The company had a forecast on an EV, target of around 40% of sales about 3 years ago. Today, the company sees only 20% of its sales being fully electric, with 40% being gas-powered and 40% being hybrid. Now, the stock's down 15% as of recording. Pretty fat. Big hit. However, Ferrari shares are up over 120% in the past 5 years. Hooray, if you had Ferrari 5 years ago, you're looking good. You more than doubled your money. Fantastic. This is what we want to see as long-term investors. Hooray. Now, lukewarm, we've got Lyft. Ticker Lyft. Lyft. The rideshare platform is down almost 7% as of recording. From what I can find, this follows investor sentiment about the broader market and the pairing of the government shutdown, and a chief economist at Moody's Analytics, Mark Zandi, warned that 22 states are already showing clear signs of a recession, placing the broader U.S. economy in a precarious position. The stock market overreacts to news. Big price drops can represent good opportunities to buy into high-quality stocks. Is Lyft one of these, opportunities? Is it a high-quality stock? I haven't looked into it. If I'm buying in the rideshare space, I'm more likely to look at Uber. And if, I form a full ID on Uber, then maybe I look at Lyft and see what are the differences like. I personally haven't looked into either. Too heavy. You tell me if you really believe in Lyft. If you use Lyft more than you use Uber, you could have a reason to look here. Again, invest in the future you want to see. Invest in the things you use. You're likely not alone. And last but not least, or actually it might be least, is Columbia Sportswear, ticker COLM. Stock is down about 3.5% as of recording. Not too bad, right? Wrong. The stock is down 36% over the past year. First thing to note here, retail is hard. Warren Buffett, famous investor, famously does not generally bother with these retail companies. They're just hard. Retail's just hard. It's just how it is. However, there's a narrative floating around that this stock is undervalued. Some analysts have it at a fair value of $56.13 a share. Wow, finance, so accurate. They must know what they're talking about. Right. This 56 is compared to a last close of 52.67. So, this consensus kind of suggests there could be hidden upside in Columbia Sportswear if the projections materialize. Now, this valuation is grounded in assumptions that highlight both structural risk for the business and room for long-term resilience. So, they got issues within the company, but there's a chance they can get through it and pull out of it fine. Looking at Columbia Sportswear's price-to-earnings ratio provides a different angle. Company trades at 12.8 times earnings. This is think about this with Ferrari here, which was at 40, and that's on future earnings. This earnings is on past, so even more, simmered down. This is noticeably cheaper than the U.S. luxury industry average of 21.1 times earnings, and a peer average, so companies that are peers to Columbia, a peer average of 17.5 times earnings. This could suggest that the stock is attractively valued to its competitors. But analysts say that's not everything. It's not a significant bargain when you look at its fundamentals. Again, the question here is, do I buy? If you don't own any stock, no, you don't. Get some money in an index fund first. Once you got that done, then we can start making individual stock picks. Fair enough. If you like the brand and you think there's a chance they can outperform expectations, do a little bit of digging. Nothing crazy, but try and build a basic idea of how the company's done in the past 5 years, maybe more. And if you're feeling really bold, compare that to some of its competitors over the same time period. As always, thank you for watching. Now that this is a YouTube show, don't forget to subscribe. Just help get the info out to as many people as possible. Help everybody get their finances in check. Nobody wants to be forced to work because they didn't plan for retirement. And remember, enjoy the rest of your day. Lock in. Get your shmoney up. Perpetual motion. For my Spotify listeners, I hope this was better over audio than yesterday's episode. I'm working on this, okay? Format's changing. I'm doing my best here. All the socials are in the description. Everything should be in there now. As always, don't buy or sell anything based solely on what you hear. I am not a financial advisor. And I don't know if I want to be. I enjoy this. But anyways, later people.
Money is the root of all evil. I see money is the root of all people. Cause we all follow paper trails. And everybody gotta pay their bills. It ain't easy, They say money is the root of all evil. I see money is the root of all people. Cause we all follow paper trails. And everybody gotta pay their bills.